Good afternoon, everyone. I'm Tyson Halsey. I'm the founder of Income Growth Advisors. I'm an investment advisor. It's a small business. I talked about gold yesterday, and makes a lot of sense. I'm also president of Optima Process Systems, where I work with a handful of engineers and investment bankers, and we look at projects and primarily projects in the hydrocarbon space, where we can clean up existing technologies or fuels and improve them to make a positive impact. And so we have a great panel today, and I thought that there would be an interesting way to present it, and it's based upon some reading I've done over the years. Phil Fisher is a legendary investor. He wrote a book called Common Stocks and Uncommon Values. And one of the things he advised is that you read scientific journals. And so if you were one of the first investors in central processing units and semiconductors or software, you made a lot of money, maybe the internet. In the physical science space, which is where we're more oriented, there's interesting new technology happening in labs, and then you need to build a pilot plant, and then you make that commercially viable, and then you potentially are a very successful company. Our panelists line up with that last kind of scenario. So I'm going to present them in this order. I'm going to make the introductions real quickly. Then each one, we have an hour here, a little less. Each speaker will speak for 10 minutes, describe their role here, and then we'll have some questions at the end. We're going to start with Vincent Liu. He's a general partner of Carbon Negative VP, and he has a deep tech VC background. And I'm sorry I'm reading this, but he really has worked in Silicon Valley or in the engineering space. He's out of Stanford University, has multiple degrees. He is setting up a fund which identifies early stage technologies that are going to be carbon negative. And that will add, and it's really more like a next generation. With most efforts in terms of carbon we know have been in renewables. So he's really looking at a very early stage, funding those companies. He's looking to raise $100 million. So I would say that's analogous to the guy who's looking at what's happening in the lab. The next speaker is going to be Matt Lucas. And Matt, I'd say, is your classic brainiac. He's working in climate positive infrastructure. He went to Harvard, has a master's and a PhD from UC Berkeley in mechanical engineering. And he ran a technology group at New Energy Risk. And so he does something different. What he does is he actually funds pilot projects. So he's looking at those guys who've taken that bench technology, and he's working, he's funded by Apollo Group. They have $100 million they've allocated that he's going to divide up 6 ways to projects where somebody's got a good bench idea and build it into a pilot project to prove viability and scale it from there. The next speaker is John Molina, who runs a very large family office. Molina is a well-known name. His father and he and his brother ran the company, Molina Healthcare. It's publicly traded, has a valuation of about 20 billion. And John, I would describe as a business philanthropist. Family wealth came out of Molina Healthcare. And what he does is he's looking to make a positive impact in terms of ESG, and he's building a business. His company is called Pacific 6. You can look it up. And, he has 6 different divisions. He's going to talk about aquaculture, like mussel farms, as well as environmental technologies he's funding. And one that really struck me, but he's got dozens, is a a seaweed that can be mixed with feedstock for animals, and it reduces methane emissions by 95%. And then we're going to wrap up with Bate, and he is the managing partner of EP Valuations. And what he does is he values companies primarily in the hydrocarbon space, but he also does ESG valuations. He was head of U.S. Technical Services over at ING Bank, and he started his career in Schlumberger. And so he's somebody who can come in, value an entity, talk about the ESG impact, and he will speak about that. So enough of the intro. Vincent Liu now is going to tell us about carbon negative technologies, his fund, and Vincent, you've got 10 minutes, and then we'll move on to the next speaker.
Great. Can you guys hear me okay?
Yes, speak up a little though.
All right. Thank you, Tyson. And also thank you, Marty, for inviting me to the event. Sorry I cannot be in person, but hope to meet some of you after the event. So the discussion here that I think I'll spend on is, the title of the topic is of the panel is ESG, right? But the things that I'm focusing on is going to be a very specific areas within the E of the ESG. And then as a venture capital fund, I can also take a step back and talk about just generally adopting ESG principles, as a fund. So a little bit of background about myself, 20 plus years operating and deep tech investment experience, primarily in the telecom infrastructure sector, dipping into also AI, energy, and blockchain. So I really enjoyed Lauren's discussion there. Most recently, I was a senior director of the corporate venture arm for SK Telecom, which is the Korean mobile operator. We have an evergreen fund in the Valley focusing on a lot of strategic deals. Engineering by training, undergrad from UC San Diego, and master's in Stanford. My partner, co-founder, also has a similar background, a PhD in physics, and collectively we've managed about 350 million AUM in respective corporate venture funds. So this is a fund number one for us, targeting 100 million, investing into across a portfolio of 20 or so what we call carbon negative solutions, and thus our name Carbon N Venture Partners. We can lead or co-lead deals with VCs and other corporate ventures. The stages that generally we're focusing on is Series A, maybe spilling over into some seed stage, and Series B as well. The investment theme that we are focusing on can be broken into basically three themes: carbon removal, carbon reduction, and climate adaptation. And I'll kind of high level talk about what all that means. The easiest way that I can kind of introduce this is think about is for all of you to think about two numbers: 420 parts per million and 50 gigatons per year. 420 parts per million is the concentration of CO2 today around our atmosphere. 50 gigatons of greenhouse gas emission on a yearly basis. A lot of capital has been deployed into electrification, decarbonization for heavy industries and so on, investing into hydrogen, solar, energy efficiency for buildings and stuff like that. But where we believe the real potential impactful opportunities is actually in carbon removal. And the difference between removal and reduction, also the easiest way to think about it is removal is about historical carbon, and then reduction is about reducing future emission. And so for the 420 parts per million, what we no matter how much we electrify our economy, that number will not reduce until you actually start removing carbon. And so that particular area also is actually the least invested today overall, the entire out of the entire climate tech space, but it's also fastest growing. And so that's why we believe that there are some real opportunities there. Today, I think the overall market size is approximately in the range of $100 billion of investment deployed into various technologies. So, there are a number of things here in transportation, energy storage, as I said, hydrogen, solar, also into food and land use. But when it comes to carbon, there are key specific areas in terms of carbon removal. So I had prepared a slide, but if you think about carbon, where does it exist? Is in the air, is around on the biosphere, is in the ocean, is all over the place, right? And so there are a variety of different carbon removal solutions, ranging from nature-based to engineering-based solutions. And all of these are at different stages of maturity. I will get into specifically like some of these examples in a little bit, but all of these different solutions are basically, the goal is to try to remove the carbon from the atmosphere and then sell ahead of time these carbon credits, for enterprise or investors for them to offset their own carbon footprint. The way that as a fund, the way that we try to differentiate ourselves, there are a number of different ways, but I will specifically talk about two things. One is what we call catalytic capital. And so what that means is that in addition to our initial equity investment, what we would like to do is also use our reserve capital to deploy on follow-on investments into specific deals, in a way that is similar to a project finance, but the solution itself is not quite at that scale yet. And so in the industry, many people call these first of a kind or nth of a kind demonstration of projects. And so we believe that that's one way that we can de-risk our original equity investment, but and also trying to fill the financing gap of some of these scale up, of the project technologies. The other way that we like to think about, differentiating is that is about measuring the impact. And so, as a climate fund, obviously we want to have some climate impact, but of course we want to bring financial returns as well. And so we are committed to basically applying ESG principles, into our process of doing due diligence, vetting companies, as well as monitoring and assessing these companies' potential impact on carbon removal, tons of carbon dioxide removal, as well as these different SDG goals, for example, water savings, land use, and so on.
2 minutes.
Yeah, thank you. And so taking a step back on, as a fund, trying to apply ESG, implement ESG principles into these things. I think the challenge with ESG in VC is that first of all, this is still a very emerging trend, for VC funds to actually adopt these principles. But but more and more funds are picking this up because there's an increased engagement, and demand, from the LPs. So in the early conversations that I've had so far with LPs, they are asking, well, how do you know you are making impacts? How do you know your investments are doing well? So these principles, by putting in there, it brings a layer of transparency for our LPs, and hopefully also aligned with their own ESG interest. But as far as the state of the adoption of ESG practice in VC, I think the challenge, the number of challenges. One is that just the early stage nature of the companies being funded. It's very hard to capture and really truly quantify exactly what the potential impact is going to be. The speed of innovation is also moving quite fast, and so things can change. Of course, and at that early stage, there's really a lack of data, on the materiality of the E or the S or the G, and so and lastly, also from a regulatory or reporting framework standpoint, I'm sure many of you are familiar with a number of different organizations like SASB, TCFD, and many other alphabet soups. But most of them are not quite suitable for venture capital reporting. And so this is still kind of an evolving trend. So I would say that for ESG 2.0, that's what is needed, at least for this, for the VC asset class. So maybe I'll pause here, and then we can talk more about details later.
Thank you very much. Let's go to Matt Lucas. Matt, are you there?
Hey, thanks so much, Tyson, for the introduction. Hi, everyone, virtually. My name is Matt Lucas. I'm the founder and managing partner at Tuatara Development Capital. Tuatara is a primordial lizard that has the interesting and unfortunate property of being very sensitive to climate change. As the temperature warms, the gender of the baby Tuataras skews male. And so the Tuataras are headed for a world without women due to climate change. So prophetic and problematic for this particular species. As Tyson mentioned, I'm also a chemical engineering PhD, so use the word brainiac. We'll get to why that might be relevant later. The role of Tuatara Development Capital is to enable climate positive infrastructure and industrial projects. And that's the hole that we see in the market. Now, what we do, project development capital, isn't an asset class per se. It's not venture, it's not growth equity, and it's not infrastructure, although we bridge from venture to infrastructure, and I'll get to that in a second. So what I'm going to do is spend a little bit of time sort of laying this out. What's the opportunity? What's the gap? How do we fill the gap? And then two exciting pieces of news. Tyson stole some of my thunder, but hopefully it won't be too bad. So the opportunity here is we have to rebuild the world's industrial infrastructure to be aligned with the Paris Agreement, right? If we're going to be Paris aligned, we have to get to net zero by 2050, one working lifetime. And we're sitting here in downtown LA, and we can look out the window and we see all the steel, glass, concrete, mobility systems, fuels, chemicals, plastics, and all of that in the next 30 years needs to be rebuilt into a net zero system. And that's a really intimidating challenge, but that's also a huge investment opportunity. So let's just take one example. US civil aviation, jet fuel. We burn about US civil aviation, not military, not international, 2 million barrels a day. That's about 10% of US petroleum consumption. American Express estimated that building the sustainable jet fuel production capacity, just the jet fuel making, is a $300 billion infrastructure play for the next 30 years. Some people might say, wow, that's like a ton of money, that's impossible. I'm really passionate about, and maybe it's because I'm a techno optimist and a engineering PhD nerd, but I get really excited about that opportunity, scaling technology, building real assets, big assets that put a real dent in emissions. And of course, jet fuel is only one of the many industrial sectors that we're addressing. So that's the opportunity. What's the challenge? So there's a capital gap and there's a knowledge gap. And let me kind of lay this out for you. On the left side, the earlier side of this, we have venture capital. So from the second half of 2020 to the first half of 2022, climate sustainability, green tech was the #1 sector for allocation in venture capital. This is true of both LP commitments into funds and fund deployments into startups. It comes under a bunch of different names. Sometimes the reporting is not really clean. Sometimes you hear it as clean tech, climate tech, green tech, tough tech, deep tech. Vincent used some of those terms too. What's happening though is that you can't, and many of these companies are building hardware industrial infrastructure, right? We're not doing dating apps anymore. And so the challenge with those kinds of companies is that at some point they need to put steel in the ground to demonstrate their value. And we learned in 2008, the last time we had a similar spur of venture capital money, is that if you put 30% IRR venture capital money into steel in the ground, it doesn't work because infrastructure capital, even emerging infrastructure, makes like low to mid teens. So that's a bugger. So somehow we have to get these venture startups, technology developers, over into the infrastructure bucket. And that's part of the gap. This technology that's being funded is across the industrial decarbonization spectrum. So think hydrogen electrolysis, carbon capture, carbon removal, new forms of power generation, biofuels, energy storage, even nuclear. All of these things often are getting incentivized both through the Bipartisan Infrastructure Act and then the Inflation Reduction Act. So we've got government policy tailwinds. So that's the one side of the gap. The other side of the gap is a glut of pension money. So this is largely pensions and infrastructure funds looking for long-term stable ESG positive returns. Infrastructure tends to make sort of low to mid teens in this case. So how do we bridge from 30% IRR venture to teens infrastructure? And the way that you get there is through the project development process. And that's my expertise at Tuatara Development Capital. So when we talk to people, we hear venture capitalists who are worried about how am I going to scale my hard tech company without getting diluted to hell? And then on the other hand, we hear about life insurers and pension funds who want to move hundreds of billions of dollars, right? We're backed in part by Apollo. They have $180 billion that they're trying to push into green infrastructure. And these folks are struggling mightily to find deals, right? So how do we bridge these two worlds? So like I said, that's what we do. Project development, let's be clear, is not investing in science projects. I want to clarify Tyson's introduction a little bit. We don't take science risk. So typically, venture funding will pay for the technology development, and that will bring it to the point where there is a subscale, what we would call pilot demonstration. That takes off the commercial risk. But you can imagine that if somebody's, say, making very sustainable jet fuel, and they're making a barrel a day, and we now want to take you to a 10,000 barrel a day facility, you've de-risked technology, but that doesn't make any sense from a commercial perspective. You don't feel like you've actually made a refinery at one barrel. So that's the role of venture. The challenge of project development is twofold. The first is that it's commercial, and then the second part is it's deeply technical. On the commercial side, I want to bring back sort of my experience. So previous to Tuatara Development Capital, I ran the front office at New Energy Risk. New Energy Risk is a large insurance company that wrote loan guarantees for clean energy infrastructure projects. You might have heard of the US Department of Energy and the US Department of Agriculture have loan guarantee programs. We were the private sector versions. We actually wrote $1 billion of loan guarantees while the Department of Energy did nothing. So we were arguably more effective and productive. Now, regardless, we had an exit, that was great. But what we noticed was that there weren't a whole lot of technology developers, venture-backed developers, who had the skill set to develop projects, right? Technology development and project development are two totally different things. So how do you bring together all these different contracts so that that fixed income infrastructure pension investor views the risk of your project appropriately? And that's especially true for the first of a kind and emerging technology, clean tech technologies that Vincent was talking about. The other part of this is deeply technical. So how do I take what you've learned from your 1 barrel a day venture funded sustainable jet fuel pilot and apply it to a 10,000 barrel a day world scale sustainable jet fuel facility, right? Because if you're going to make a commodity like jet fuel, you have to do it at scale. And infrastructure doesn't work below 9 figures anyway. And that's deeply technical, and that's where my team's technical background come in. We've yet to do a deal where we haven't made fundamental engineering corrections to their documents. And that's part of the de-risking here, is that we can get into the weeds and actually make sure that these things are going to work out.
2 minutes.
Great. So the two big pieces of news I want to share. The first one, Tyson beat me to it. So we're we're out raising our first capital vehicle, and we're pleased to announce that Apollo is going to be our anchor investor. So it is $100 million. Yeah, thank you. Right. Why Apollo? Right. So we as Tuatara Development Capital investing project development capital make private equity-esque returns. And then we tee up these opportunities to deploy infrastructure capital, which typically make mid-teens returns. It's great to be paired up with Apollo, who both has a private equity appetite, but then also has hundreds of billions of dollars worth of potential follow-on to do those co-invest into those infrastructure assets. Likewise, for a family office, I think this is a great opportunity here because you can have the confidence of investing alongside Apollo and that oversight, but you also have access to that if you're interested into the investment into the real asset, that infrastructure asset that generates the long-term, stable, highly contracted returns. The second thing is our second project is live, and this is one that I think can give you a sense of what we're working on. This project, it's about $400 million on the US Gulf Coast. It uses chemical recycling to take used motor oil. This is what comes out of your car at the Jiffy Lube, and uses a proprietary cost and carbon advantage process to turn it back into virgin lubricant. No tax credits, no Inflation Reduction Act incentives required. It's a pure play technology issue. And this is gonna be a first of a kind facility. Offtake is with really highly credit rated oil major. But again, because this is a project that's been passed on by many others, and it's because it was deep tech, new chemistry, was really difficult for a Wall Street bank to address without Tuatara's expertise. So this one's in market now. You know, we're in a position where that's a great spot where Apollo will take this entire deal if we want. We're going to put 15 million in to develop it, and then there's this $400 million later to build it. But there's an opportunity to basically co-invest with Apollo, extend that capital. So really appreciate the opportunity to be here. Thank you, Tyson. Thank you, Marty. Looking forward to the rest.
I had a question.
Matt, that was great.
Tyson,
Go ahead,
question.
Marty.
Yeah. So my question is, every deal you look at have an off taker?
Oh, yes.
Is that like part of your strategy? Because a lot of people will invest in a deal that there's no off taker, there's no strategic, or they haven't thought about it. But it seems like that's something that you're really consider in when you.
Absolutely. So a key premise of project finance, remember, how do we get from venture risk to pension risk? And part of bringing this down is by having what we call contracted cash flows. So I know who I'm selling my product to, on what specification, on what price. We will not do a deal without an offtake, and that's generally true of project finance generally.
It's a very common private equity approach, sure. Yeah.
There are definitely industrial assets, think like car factories. It's an industrial asset that doesn't have an offtake, like you don't know who you're selling your F-150s to if you're Ford Motors, in which case you have to do this on more expensive corporate equity. But if you can find that offtake, and that's one of the key commercial challenges and part of what we value add, if you can find that offtake, you can move off of the world of dilutive corporate equity into the world of off-balance sheet, non-dilutive project financing, infrastructure financing.
John Molina, please.
Thank you, and thank you, Marty. I'm going to take a little different approach. It's a kind of a long and winding road to get where we got. I remember, it seemed like yesterday, but there was a time when I was the youngest person in every meeting that I was in. And now I find that while I haven't aged, the other groups have gotten a lot younger. I am not a brainiac by any spell of imagination. And I really got into business for the family reason. And I think as Tyson mentioned, my father started a company called Molina Healthcare. He was a physician. His goal was to take care of people who were on the lower end of this economic spectrum, people on Medi-Cal, Medicaid, people on food stamps. And when he started the company in 1980, everybody told him, you can't make any money taking care of poor people. And he said, well, that's not really the purpose of the business. The purpose of the business is to take care of people. And he built the company. He passed away in 1996. My brother, who was a physician, became a CEO because, frankly, although I've been the longest tenured employee after my dad, it didn't look good to have a lawyer in charge of a healthcare company. So not to say that my brother wasn't a great CEO. We actually went public in 2003 And when he and I left in 2017, we were a $19 billion company operating in 33 states, taking care of 4 million people with 23,000 employees. When I left the company, it was like, well, what do you do now? And I know a lot of the discussion that folks have had in the last few days talk about risk, financial risk. And I look at risk a little differently. And going back to all the discussions we've had now about Silicon Valley Bank, and look, guys, back in 1980, we had something called the S&L crisis, right? And the world was going to end and finance was going to crumble, and we survived. 10 years later was the dot-com blew up. And the world was going to end, the economy was going to go bad, and then it was Y2K, and then it was 2008. And it's kind of, capitalism is great for innovation, but for some reason on the finance side, we don't seem to learn the same things over and over again, right? So what I wanted to do when I looked at risk was not the financial risk. What is the risk to the community? What's the risk to and frankly, what's the risk to my family? I've got 2 kids. Neither of my kids were going to be engineers. Neither of them were going to go into tech. My daughter went into public health. My son's 21, trying to figure out what the hell to do. And so what's the world going to be like for them and for my grandchildren? I was very fortunate because we part of a successful business. I live on the water in Long Beach. That's great. Things go on the way they are. In about 10 years, I'm going to be underwater. So things are moving fast in the ESG world, and I emphasize on the E and the S. And so it was talking to people, what's missing? And excuse me, I'm sorry. Pacific Six is there's 5 of us, 6 of us, me and 5 others, guys that I trust. And we didn't really have a business plan, but it was, we want to do something that's going to help. And it is 90% my money, and I was able to convince my siblings to throw some money in. And we started looking around for companies that had a positive contribution, but lacked capital because people would look at it and say, you have no track record. And I've been to a number of conferences and I ask people, why haven't you invested in aquaculture? And the answer is always the same thing. We want to be the first investor in the second company that's successful, because we're afraid of the financial risk. I'm not really that afraid of the financial risk, because I believe that if you do it right, you can get through the regulatory hurdles and you can make it work. Sometimes you succeed, sometimes you fail, but somebody's got to be the first one through. I actually thought I'd call our company the tip of the spear, because that's kind of how we feel sometimes. And so Tyson mentioned there's a couple of investments that we've done. We like to be part of it. We like to put our own money out there so that at the time we bring other folks in, they know we have as much skin in the game or more so than they do. And we think that's important. It is not to say the venture world is bad, because the venture world can raise a hell of a lot more money than I can. But we just have a different approach. So we got into aquaculture. We have a company that has the only permit in the United States to grow seafood in federal waters. Most of it is done in coastal waters, and they're very small farms. The other thing that we've learned is commercial fisheries have plateaued. So no matter what we do on the commercial side, you're not going to get any more seafood from a commercial fishery. So we've got to grow our own. And that's what we've done. We had to work out, because it hadn't been done before, a regulatory scheme with 6 different state and federal agencies. And we've been working on that for about 3 years. None of them wanted to be the first or be the most responsible. We finally got through that. So we have a mussel farm It's 100 acres. We're going to grow it to 1,000 acres. Mussels are wonderful because they have wonderful omega-3 fatty acids, just like salmon. But they also, through their mussel shells, store carbon. So, Vincent was talking about carbon in the future. Mussel shells do that. We're also going to grow seaweed because seaweed is another thing that stores carbon. In order to farm, you got to have the right tools. Nobody was doing what we're doing in the US, so we went down to New Zealand where they do a lot of mussel farming. We got a naval architect and we built the first mussel boat ever built in the United States. And the second boat we're just starting on right now will be a hybrid boat. And we're hoping that the third will be an all-electric boat. And no, vessel. I'm not allowed to call it a boat. It's a vessel. But that's the things that we're trying to do. And just along those lines, we happen to come across another type of seaweed, as Tyson said. It's a very particular type of seaweed that if you add it to cattle feed, cattle and sheep feed, you just need less than 1%. But within that animal, it combines with the food they eat, and it reduces their methane output by anywhere from 80 to 90%. Now, most people think it's, cow farts, it's actually burps. But in a state like California that has a mandate to reduce methane output by, I think we're talking about 40 or 50% in the next 10, 15 years, this is a solution. Not the solution, but a solution. And so now we're trying to figure out how do you grow it scalably. The other project that we had deals with recyclables. Dirty little secret is put your recycled plastic bottles and stuff into the purple bin and they take it away, and it's not economic to recycle, so it goes in the landfill. We have a company that has a technology that will take that organic waste, whether it's plastics or whether it is wood or any kind of waste, and it puts it through a number of different high temperature chambers and eventually eliminates and pulls apart the gases so that the end product is carbon monoxide, which we can sell to cannabis growers or to Coca-Cola bottlers, et cetera. And about 60% of it turns into hydrogen, which we can turn into electricity. Because as much as the states of Washington and California and New York and Maryland say we've got to go to all electric cars, we do not have the infrastructure, nor will we have the infrastructure in 2050 to supply power to all those cars. We don't have the grid, we don't have the production, so hydrogen, we think, is an alternative. And it's very interesting, being a California person, 2 years ago, if you recall, the big articles were, my God, California's burning up from all these wildfires, and oh, it's now spread to Idaho and Washington and all these other places. And there's a drought, and pretty soon we're going to be battling over water. And now what is our big worry? Our big worry is a big old snowpack that's coming. So whether you believe in the causes of climate change or not, the effects are real. And that's kind of how we look at it from a business standpoint. And so if we can take take some of the plastics that has been going in the ocean and turn it into something that's really workable, maybe it's aviation fuel. If we can take the branches that fall to the ground in the forest and rather than have them become tinder for massive forest fires, we turn them into hydrogen fuel, then we've got something. And so that's always been our approach is, what can we do? What can we invest in? What can we do to convince others to join us? Because we got lots of skin in the game. And maybe we can help meet those 2050 Paris Accord requirements. And maybe we can prevent Las Vegas from being a beachside town in 100 years. And so that is how we've progressed in the last, now it's 6 years with Pacific 6, and it was 37 in healthcare.
Just a quick comment. I have some great introductions for both of you, so let's talk after the.
Sure.
Thank you, John. That's tremendous. To finish the quartet here, Bate will reintroduce himself and talk about what he sees kind of on the bleeding edge of scientific progress in terms of ESG in the energy space, and things that his company does and how they might work with varied types of customers, including those on the panel. Go ahead, Bate.
Thank you. Thank you, Tyson. So it's good to be here again. My name is Bate, and I'm with EP Valuation. And we are a firm that provides asset valuations, technical due diligence, and ESG reviews for financial entities, operators, and sponsors in the energy space. We're based in Houston and Dallas, but the banks we support and the clients they fund all over the United States. We think of the work we do as empowering our clients to make better investment decisions in what is increasingly a challenging energy landscape. Now, over the past 2 years with the post-COVID recovery, we've performed over 100 valuations on assets from 25 million to 5 billion in transaction value. My background is engineering. I'm a licensed engineer in the state of Texas. I also have an MBA degree from UT Dallas, and I've been in this space for 22 plus years. Now, EP Valuation does ESG reviews, which perhaps is more appropriate for this panel, in that we help banks review oil and gas companies from the perspective of what can they do to reduce the energy footprint, right? What practical steps in the field can they take to improve operations, decrease emissions, and as a result, get a better, if you would, emission, carbon footprint. But lately, I found myself in meetings with oil companies talking about energy transition and the renewable space. And I bring this up because one of the things I've brought up to oil companies is we need to think of ourselves in the oil and gas space as energy companies, not just oil and gas companies. And that opens doors to various areas in this business. I'll give you an example. There's always this saying that you can't fly a plane on solar panels. Okay, so that's true right now. You cannot fly a plane on battery technology. Okay, that's fine. Or you cannot fly a plane, on wind power. All fine. But there are a few companies in the renewable space that are making the issue of high density fuel a reality. Right? So I'll start with Neste. It's a Finnish company. It's an old company. It used to be a refining company. And over the past 15 or so years, they've pivoted towards renewables, right? And so they convert vegetable oils, waste fats, and similar material into high quality, low carbon fuels, right? They partner with distributors to blend the fuel into, traditional aviation fuel. Some of their clients are JetBlue, Lufthansa, KLM, Finnair, right? So this is a company, and I believe the city of Oakland actually uses the biodiesel on city buses, right? Now, their fuel reduces carbon emissions by about 80% compared to traditional jet fuel, right? There's another company out of Colorado called Gevo. Gevo converts a plant material, biomass, corn and other materials into low carbon fuel. And Gevo signed recently a deal with Finnair to provide 7 million gallons of renewable jet fuel over the next 5 years, right, at the price of about $5.50 per gallon. Now, in terms of just benchmarking that number, regular jet fuel is anywhere from $4 to $10, depending on oil prices. So these are two companies, and they're not the only two, but the two companies that are knocking on the door of sustainable aviation fuel and commercializing it. Right? So the question is, can they scale it up? And I believe there's capital that could flow into companies such as this to scale them up. There's another company called 3rd-4th. Now I'm bringing this up, these companies, not just to endorse them, but just to discuss the technologies in this space that are coming up that I try to bring to the attention of my oil and gas clients. Right? A small company called 3rd-4th. I believe in the first fundraising round, they raised about 140 million. Second round, about 50 or so million. And 3rd-4th plays in the carbon sequestration and carbon transformation space. So they use captured carbon to turn that into fuel. They can create methane, ethylene, jet fuel from captured carbon through an electrolysis process using the catalyst. So essentially, you get fuel without any of the hydrocarbon production, right? It's a small company. For the cost of about 10 shale wells, you could fund a company like 3rd-4th. That's really how I put it, to oil and gas producers, right? You can do 10 shale wells, or you can fund a company that is at the leading edge of this renewables process. And 3rd-4th has partnered with Alaskan Airlines to test their fuel. Right? Now, the gentleman talked about hydrogen. There are two companies I'm going to mention that are, beginning to crack the code in the hydrogen space. One of them is a company called Fusion Fuel. The public company, they've raised some money, and they build essentially an electrolyzer, right, that uses solar power and water to create hydrogen, right? So you end up with green hydrogen that's be produced off the grid at commercial rates. And the last company I'll mention just quickly is a company called Enapter, German-based company, small company. In 21, I believe their revenue was 9 million, in 22, 14 million, but they expect to do 10 times that this year. Now, what does Enapter do? Enapter has figured out how to make scalable electrolyzers at low cost. And last year and into this year, they've received orders from utilities in Canada, Taiwan, and the Netherlands. And those orders are almost 10 times what they saw in the first 2 years of the existence. The goal of Enapter is to reduce the cost of green hydrogen by about 80% or so. Right? So these are companies that are essentially beginning to crack this code of high density fuels. And it matters because unless we do, we can reliably move from hydrocarbons into the renewable space. Now, when oil and gas clients say, well, but why should we go into that space? I just say, because there's money in that space, right? Based on the legislation that is currently out that Lucas mentioned, there's probably 400 to 500 billion going towards renewables in the next 5 to 10 years. And we know from experience that for every dollar the government puts out, $2 to $4 will follow it. That means there's potential for $1 trillion over the next 10 years to move into this space. So again, to my oil and gas clients, I tell them one very simple thing. You don't have to change who you are. Just extend your runway by investing in companies that are at the leading edge of this process. I'll stop there because I think there's a lot of value that could be had in this conversation, and maybe Lucas can get in and Vincent as well.
Well, I'd say that's tremendous. It's very exciting. Go ahead. It looks like John, you had a question.
I love the last statement that Bate said is you don't have to change who you are. You just have to extend your runway. I mean, that's it right there. Right? You are, these oil and gas companies are successful. The companies that you work with are successful. There's a reason they're successful. And don't forget that reason is because you got really smart people working for you who really are dedicated to doing something. So you just kind of need to redirect and expand that.
And now they're actually spending a lot more money on ESG. And what's really key is our ability to bring these ideas to them.
Question from the audience. Can you hear me, Tyson?
Yes.
Okay, it's Rob Colorina. A couple questions. First one for Matt. I was also with Apollo earlier this week at some of the things around milk and so you have the green Apollo colors as well.
Well, it's our branding, but yeah, no, oh shit, well.
But I mean, yeah, I agree. They're a respected name. How often do they do that? Do mega funds like that do that in the industry? Because that's very interesting. At the same time, they're there for backstop, but you know, it's interesting that they would even focus on something this small on your end. You know, whether it's $100 million allocation, and you know, what's in it for them to provide sort of the larger financings or equities, you know, post. So that's my first thing, and then I have something for John.
Great. So because we return private equity type profiles, Apollo putting in 8 figures to Tuatara Development Capital is like a perfectly normal sized private equity check for them, realizing that, you know, we get these projects to construction financing. You don't have to wait 10 years to know if I'm good at what I do. You wait like 12 to 18 months. So they're very focused on, do we very quickly go from being call it a $50 million allocation with a $50 million family office co-invest, and they've got their own capital markets people work on this, to a $500 million, right? We just talked about all this IRA money. Like, project development capital is not going to be boutique if we are going to be what I do, right? Can't remain boutique if we're going to scale. Now, separately, so that's just like by itself. It's a great PE return. We have conviction we're going to deliver more than 20% IRR. Now, there's also that option value that you generate for the infrastructure folks. And what's happening right now is everybody who wants to do ESG investing goes for utility scale, wind and solar. And that has driven yields in that space into a trough. And that was okay when interest rates were 0, and now it's totally unacceptable. So they're looking for different infrastructure funds call this different things. Some of them call it emerging infra, next gen infra, core plus. But they're looking for stuff that generates, let's call it mid-teens IRR lever.
I get it. This is like the smart guinea pig type of thing. And
I mean, so Matt's model was actually something that a family office in our group did a while back, maybe 15 years ago. It was incredibly successful. Yep. So, and I think there's lots of ways to structure it. And it wasn't in ESG, but it's ESG. And actually it's something similar to what you're doing with the aqua farming. Yep. So I think that there's, as long as you have an offtake, you've got something very sellable. So
then my follow-up, actually, I'm thinking with Vincent and Bate, the corporates here are acting different. And Vincent, I think you said you were at SK, the Korean, you know, the Korean entity. But you know, and John, are you at this point about methane gas? Are you seeing corporates being that much more ESG sensitive? You know, I think we have some gray hair here. That's much different than a decade ago, and you know, and how far downstream does that go? So that's for, you know, the rest of the panels. Yeah.
Want me to go? I'll give it a shot. Yeah, I'll give it a shot. I mean, from the perspective, from the perspective of SK and many other corporations, I think with you know, you may have heard of this thing called voluntary carbon market, and you know, a lot of corporations now are really making an effort, you know, trying to decarbonize and meet their own net zero goal by a certain time, you know, 2030, 2035. But the reality is that, especially in heavy industries, industrial, automotive, and even telecom, they are not going to decarbonize fast enough to meet these goals. And so, so there's really an effort trying to figure out how to reduce, but then also find ways to remove. And you probably have also familiar with this new carbon marketplace called Frontier, which is supported by Meta, Microsoft, and many other big corps. And you know, the goal here is to really look for long-term capture of carbon, and then in turn there are these credits. Then corporations can offset their own footprint. I guess from the perspective of SK, they have been, I mean, from as far as I can tell, and telecom is only one of their many entities, right? But overall, as an SK group, I think they are making huge effort in trying to, find ways to be more green. They are definitely investing heavily also outside of SK Telecom, but other SK businesses investing in hydrogen and battery materials for electrification.
Bate?
Yeah, so I'm going to talk about carbon capture just for a second, because I think carbon capture is shaping up to be, at least in the energy space, one of the leading go-tos for carbon removal, right? Now, Exxon, for example, recently announced a $100 billion carbon capture project. Talos Energy also announced, carbon capture projects in the kind of the Gulf Coast. The oil industry knows a lot about reservoirs, and carbon capture really is about reservoirs. Now, based on the Investment Reduction Act, about 70% of your costs in carbon capture, if structured right, can be recouped through tax credits. So there's a great incentive for these projects, right? And that is the key in the oil and gas space, to connect companies with carbon reduction, because we understand reservoirs, we understand how to find them, how to manage them, and how to put carbon away. There are a few companies in this space that do that already. There's Denbury, for example, there's Continental. These are companies that have smaller, well, actually Denbury has a very large business process of carbon capture and use, right? Because they use carbon in their oil recovery process. And so carbon removal, I think, is happening in the oil and gas space because it's a natural part of the business we do. Now, a company like 12 and similar companies will need other technologies to capture that carbon from the air. But I think the key here is that the more we invest in companies that are using renewable carbon, the more we incentivize those that are willing to capture the carbon and transform it or store it. So there is potential for storage. We just need more companies to get involved in this space and make it commercial or make it economic, more likely.
Thank you.
I was just going to say, corporates don't need to put their money in, they need to use their purchasing power. So let me use a fun example about a weird offtake. One of the challenges with doing aquaculture or vertical farming, which are two of the emerging segments, and it sounds like John does some of this, is that nobody buys tilapia fillets or butter lettuce on a 10-year contract. There's no offtake. So it's been very challenging to project finance. You know who wrote the first offtake for romaine in the United States? Walmart. It was 0.001% of their catchment radius for this particular facility, but they got so damn frustrated because they'd have a salmonella outbreak every year at Thanksgiving, and then they'd have all the bad PR of recalling the romaine lettuce over Thanksgiving dinner. And so they said, you know what, we're really confident that this greenhouse vertical farming solution isn't going to have salmonella, and therefore that's why they signed the offtake. So I would say, don't go chasing the corporates for their dollars. That's actually very challenging. Just say, hey, if we make it, will you buy it at market parity? Walmart's not paying a green premium for that romaine lettuce, I want to be clear. But that's a huge win for that project, right? If Walmart hadn't stepped up and made that 10-year purchase commitment, that vertical greenhouse would never have been built.
It's interesting. Our financing model is a little different. It's tough I think as a public company to make some of the investments. Ford came out, I think it was a couple of days ago, and said, we had great, phenomenal profits on our traditional business, and we lost a ton of money trying to do EVs. Well, if you're a public company, and I was a CFO of a public company for 13 years, it is almost 90% what does next quarter look like? And I remember going and doing quarterly, earnings releases, and literally the next day was, what does next quarter look like? Right? You don't have time to do some of that. With our philosophy is this. Again, I was fortunate, made enough money. I don't need to have venture returns. So if I bring someone in as an investor, they can make the venture returns or more because they've got to go out and solicit people, right? There's competition for that money. I've done okay. I don't need to have that. I just need to have enough to give to my kids and grandkids and expand some stuff. On the other issue about the offloading, a lot of it's education. I mean, one of the reasons that we got into aquaculture is people don't realize 80 to 90% of the seafood we consume in this country is imported. And that has a huge impact on climate when you are flying things in from Vietnam, or you're flying your food in from Japan, or even if you buy it here, I mean, even if you catch it here, we have to send it overseas to process for them to send overseas back. So how do we resolve that? Is to begin to grow that industry here. You mentioned the salmonella. One of the other companies I didn't talk about is ironically, it's a medical testing company that has been able to come up with a test that can, within 10 minutes and a very small sample, find out if there's a bacteria, a harmful bacteria. Originally, it was started by a guy who was a trauma surgeon who said, sooner I can find out if the surgical, the surgery I just did is contaminated with a bacteria, sooner I can put somebody on the right medicine. Well, lo and behold, he can use the same concept to test food. In fact, they've got a contract now with Coca-Cola to test milk in Ecuador. So there's all kinds of offshoots that you can do. And imagine the savings if we could test our food products for salmonella or E. coli or whatever before there's a huge recall.
So I'm going to take the issue of oil and gas companies just because I saw that in the chat. You know, when I speak to oil and gas companies, I give them a few numbers. Over the past couple decades, Exxon, for example, has spent $1.6 billion in fines on a series of incidents, spills and things like that. Marathon has spent about 1.5 billion. Those are two large companies, but 1.4 billion is still good money, regardless of the size of the company. And the question, of course, is if we could help these companies redirect that into front-end investments on ESG to reduce emissions, would that money not be used in a different area rather than on fines, right? So really, I think the conversation is not so much about money. It's about if you're going to spend money anyways, where could those dollars go? And we think on the front end, on ESG and better management and better field operations, rather than on the back end when EPA comes knocking on the door, there's a spill.
Tyson, can we get closing comments from everybody? Just to take a minute to, thoughts we should be left with in terms of the subject matter.
Okay, let's go Matt, John, Vincent, and then Bate.
Rebuilding the world to be net zero is really intimidating, but really exciting and an incredible investment opportunity.
I just want to say, I personally learned a lot. I'm so impressed with these folks and the people I've heard before. Used to be a pessimist. Now I'm an optimist. I think that the brain power and the money's behind the right things. And frankly, I'd much rather spend it on new methods of energy than on chat rooms where teenagers belittle each other. Even though that's a hell of a big business, I'm not sure it contributes a whole lot to the society that the folks here are doing.
Vincent?
As many of you can tell, I mean, I don't have any more gray hair left, but I think there's a lot of momentum in the market, from government support and also the private industry on a global basis, right? The investment thesis for our fund is achieving carbon negative on a global scale. And I think that a lot of different specific areas within the E of the ESG that is worthy of investments. And I think there's a very, very good future in the next decade plus.
Thank you, Bate.
Yeah, thank you. Well, I would say I'm optimistic because I believe that the investing public is demanding low energy products. And that is important because what that means is that the pension funds that can drive a lot of dollars and be patient for returns over a very long horizon can begin to think about investing in carbon, in low, clean tech, low carbon, and renewables technologies.
Well, I want to thank Marty. He put together a great group, and I hope we can start putting our minds together and making more of this a reality. We have the audience and clearly the talent here on the panel and elsewhere. So thank you all. Thank you, Marty.